Hello, and welcome to The Intelligent Investor, authored by Benjamin Graham and summarized by yours truly, Leonard Strovich. Before we get started, a little background on Mr. Graham. Graham grew up in a poor family where his mother struggled to make ends meet. After winning a scholarship to Columbia University, Graham lost a large sum of money during the great stock market crash of the late 20s. But between the years of 1936 and 1956, Benjamin Graham gained at least 14.7% annually. The intelligent investor, as I quote, is a realist who sells to the optimist and buys from the pessimist. The secret to your financial success is inside of yourself, and in the end, how your investment behaves is much less important than how you behave. Chapter 1. Investment, not speculation. According to Graham, investment lies in three equal parts. Invest in companies that interest you, protect yourself against serious loss, and you're no Babe Ruth, don't swing for the fences, settle for adequate performance. Defensive strategy, never ever be too emotional, safety first, and nothing too bothersome, as opposed to the enterprising strategy. How much time and effort are you willing to spend, both physically and intellectually? Chapter 2, Inflation, where profits are only measured after you account for inflation. And just like taxes, inflation should always be a factor to consider, as it will most likely never go away. Stocks do 80% of the time outpace inflation, and other options include REITs and TIPS. Chapter 3, the stock market history. The value of an investment is and always must be a function of the price you pay for it. The less you pay, and the more the stock rises, the more that you're going to gain. Don't always or ever buy into a bull market. Interpret, but do not solely trust the insight of the experts. Stay humble about your forecasting powers, as you are no god. You can never forecast the future by exclusively extrapolating the past. Technical analysis, not today. The defensive investor and principles. Not how risky an investment is, but how much time and effort you are willing to apply. Age should not be a gauge of how risky, but how much you are willing to lose. As Graham suggests, 25% in bonds and 75% in stocks. Maybe a little less in bonds today, but that's just given the rates. The more familiar you are with a stock, the more likely it is to turn a sound investor into a lazy investor. Don't let the ease and up-to-minute feel of the internet seduce you into becoming a speculator. Remember, buying in small increments over many years can trigger huge tax burdens, so be prepared to keep an extensive record. Always diversify. 10 to 30 stocks, as Graham recommends. It can be done with a little less, maybe 8, but don't ever overexpose yourself to any single industry. If you set up a defensive portfolio and find yourself tending to it more than 2 to 3 times a year or 2 hours monthly, something went terribly wrong. Chapters 6 and 7, Policy for the Enterprising Investor. A company can perform great, but if you pay too much for it, it is a poor investment. Avoid IPOs, it's overpriced, and avoid day trading. It's too costly and time-consuming for the intellectual investor. No junk bonds with a BB rating or lower. Have caution when buying foreign bonds. Keep operating expenses less than 1.25%. The bigger the firm, the slower it grows. PE ratios between 25 and 30, maybe a little bit too risky. Temporarily unpopular stocks give you, the intelligent investor, the chance to buy low at a great price. And again, diversify those bonds. You cannot predict the future. Foreign bonds help when trouble rises at home. Investor and market fluctuations. If you do choose to speculate, keep those eyes wide open. Be sure to completely separate this from your investment program. The sound investment is bought at or very close to asset value. Consider the PE ratio, strong financial position, and steady growth of earnings over time. A speculator anticipates and profits from market fluctuations as the investors acquire suitable securities for a very suitable price. Investing in investment funds. The average fund doesn't pick stocks well enough to overcome its cost of researching and trading. Therefore, the higher the expense ratio, the lower the return, in the inverse relation. The more a fund trades, the less likely it earns, and highly volatile funds will likely stay volatile. Funds with high historical earnings are not likely to remain winners for long. Index funds and what to look for. Chapter 9. What to look for. Management is the biggest shareholder, Index funds are cheap, they dare to be different, they don't take on too many clients, and they don't need to advertise. How to view a fund. Expenses, the riskiness of the fund, the manager's reputation, and lastly, historical earnings. Be careful how you view the fund, as many view the fund 4 through 1 instead of 1 through 4. Chapter 10, Investor and His Advisor. A full-time investor requires a $100,000 investment, so until then, Graham recommends index funds. What to look and ask for when seeking an advisor. Investing philosophy. Does he solely invest as an asset manager, or does he advise on taxes, estate, and retirement, insurance, or debt? Stocks or mutual funds? How do you track and report my process? Progress. Do you provide a checklist? Do you use technical analysis or believe in market timing? Because if you do, I don't think we're going to be a great match. Other red flags should be raised if the fees are greater than 1% of the asset value, if the advisor promises at least a 10% return, or advisors who will not show you their Form ADF, a professional requirement. 11 and 12. Continue with security analysis for the lay investor. Fundamental analysis is an estimate of value and a comparison to the current market price. Graham makes it clear that any analysis that uses more than a simple math and algebra is bogus. What to consider to avoid overpaying for a company. Firstly, the long-term prospects. Secondly, the management quality. Third, the financial strength and the capital structure, which can never be overlooked. 4, the dividend record. And 5, the current dividend rate. If they have given dividends in the past, are they still giving dividends, and at what rate? Chapter 13 is a comparison of 4 listed companies. It starts off with the 7 statistical requirements for defensive portfolio. Make sure it's of adequate size with sufficient financial condition, continued dividends for 20 about years, no earnings deficit for at least 10 years, 33% increase in per share earnings over the last 10 years, the price less than 1.5 times net asset value, and the price about 15 times the average of the average 3-year earnings. So take 15 and multiply it by the average of the previous 3-year earnings. The 4 companies were ELTRA, Emerson Electric, Emery Air Freight, and the Emhart Corp. The chapter compares the companies of chief elements such as the profitability, stability, growth, financial position, dividends, and price history. Emerson and Emery traded at high multiples compared to the other two, and Graham prefers Emhart and ELTRA because the price relative to the PE and the book value, along with stable earnings, of course. Chapters 14 and 15, stock selection for the defensive and enterprising investor. The enterprising approach has the same foundation as a defensive strategy, but provides a little more flexibility. For example, the current assets to be greater than 1.5 times the current liabilities, and debt should not be more than 110% of the net current assets. Earning stability, no deficits. Dividend records, some current form of dividends. And earnings growth, last year earnings more than the previous year earnings. Chapter 16, convertible issues and warrants, discusses the pros and cons of convertibles, investments which behave like stocks and work like options. You can keep the bond and earn interest, or you can exchange it for common stock at a predetermined ratio. The intelligent investor does know, however, though, that convertibles offer less income and more risk than other bonds. Unless you are set only on holding bonds, convertibles are not your best choice. 4 extremely instructive cases. Histories of Penn Central, Ling, Temco, and Vought. Penn Central couldn't cover all of its interest it incurred. The company had inefficient ratios, overstated earnings, and took on too much debt to be able to keep their head above the water. LTV had similar debt problem and also overstated equities per share because it did not include preferred stock. Meanwhile, the bank continued to fuel the fire with more financing. And down she went. NFV Corp and AAA Enterprises. NFV took over Sheraton Steel, a company 7 times larger, and tried to use accounting procedures, fancy work, to skew and hide value. AAA started a mobile home business that was overvalued and hit a PE ratio of more than 100. The company went bankrupt and shareholders were left with nothing. Chapter 18, a comparison of 8 pairs of companies. The companies show how markets are not efficient as companies can be both over and undervalued. Both over and under. As a company grows, debt becomes harder to manage, and so proceed with caution. PE ratios can signify many things, and always consider the book value. Just because it trades lower than 100%, again over and undervalued, does not mean it's a good buy. Stable and consistent growth should never be overlooked. Consistent, stable, and for a prolonged period. Chapter number 19, shareholder and management. A stock split is an issue of new shares in a company to existing shareholders in portion to their current holdings, i.e. market cap remains the same while numbers of shares increases or decreases. A stock split, though, often does boost demand. The price looks more appealing. If a stock's trading at $100 and then drops in half to 50 or even a quarter to 25, you can buy 4 shares for the price of the old 1 share. Lower the price, more affordable. Often, earnings and the increase in value continued over time, so the price increased over time. So it will continue to do so in the future, right? Dividend is a tangible evidence of earning, and often 2/3 of earning. If no dividend, demand a need for a clear-cut demonstration of how the reinvestment is increasing per share earnings. Number 20, and the final chapter, the margin of safety as a central investment concept. In the ordinary common stock, bought for investment under normal conditions, the margin of safety lies in an expected earning power considerably above the rate for bonds. The intelligent investor must focus on getting their analysis right, but also understand taking into precaution against the inevitable event of making errors. Thank you for your time. Again, my name was Leonard Strahovich, summarizing Benjamin Graham's The Intelligent Investor, and I hope you learned something today. Thanks.